This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
So let's deal with the two separately. First of all, forget gearing completely. What are we going to do if the risk of the project is different? All right? I think you all know what I mean. I say forget gearing. Assume we're all equity finance. Gearing's irrelevant. But, I'm currently a telephone company with a certain level of risk. We're going to start a big new project, which we're going to set up an airline, which has a different level of risk. How are we going to decide how to appraise, how to discount the airline? Okay? Now, although, as I said, essentially this becomes a capital asset pricing model, which you may or may not remember bits of it. One thing that is new to this exam, Reda, sorry, she's overexcited, she's done the next 4 chapters already. One thing that is new to this exam, as against F9, is before we get into capital asset and how we'll use it, it's first of all, as I say, a lead into it really, but to talk more about what we mean by the risk of the business and what's involved, okay? And so it is in a sense a lead into capital asset, but it can be asked all on its own. And the chapter's called Portfolio Theory. It's page 29. The first bit of it actually isn't, but you'll see what I mean. But it's a question of what do we mean by risk? It's easy to say, an airline is more risky than telephone, but what is it and how would you measure it? Well, what we mean by risk is quite simply the fact that you're not certain of the returns. What I mean is, if you were thinking of doing an airline, starting up an airline project, if you were certain it was going to give a return of 10% a year or something, then we'd say there was zero risk. In real life, of course, you might expect, if you like, an average return of 10%. But clearly, some years it might be better, some years it might be worse, And the more it's likely to fluctuate, the more risky it is. You've had that bit before, but we are all clear, I hope. It's the fact it tends to fluctuate. If it's always going to be 10%, the risk is zero. If you have average, it's 10, but it might be 11, it might be 9. Okay, there's a little bit of risk. If it's average 10, but it might be 15, it might be 5, well, there's more risk. Okay? And appreciate, risk isn't sort of in itself necessarily bad. The risk is the fact you might do worse, you might do better. Okay? Well, the first thing is, how might you measure it? Now, it's a bit theoretical, but even so, given that the risk is the extent to which it fluctuates, how can we put a measure on the risk? Well, the standard measure is something called the standard deviation. Now, you'll never, in fact, get asked to calculate this, but because you can be expected to use this measure, I'm not prepared to just say, it's a figure in a formula. No, I think to make sense of it, and for any discussion, any written bits at all, you should be clear basically where this figure comes from. So although I've written a formula on page 29, you're not actually going to need that formula, all right? You're right here, Reda? But it only takes a few minutes. It's not going to be your problem. But let me show you with a very baby example what this standard deviation thing is, because I say you're very likely to need to use it, even though you won't ask you to calculate it. But it's a very baby example, but it's all we need to illustrate. Look at example 1. The following are the likely returns from Z and the probability of each. So we're saying if we do this, this company, it's either going to give us 10%, 15 or 20. So clearly there's risk. Yeah? Might be higher, might be lower. We know the probabilities of the returns. It's 0.2, 0.5, 0.3. And I want to have a measure of risk. I said before, if it was always 15, there's zero risk. But given it might be high, might be lower. You're all clear what I'm getting at? Well, to do it, we do two things. We first of all work out what's the average return. Well, this should be no problem. To get the average, you've done this enough times. You multiply by the probabilities and add up. My head went funny in the middle, so you better check me. I think the average is 15%. 15.5. Now again, that you've done before in many places, but we're all happy. I say, I mean, it's very impractical, obviously, but I don't care, it's the principle. So on average, we're getting 15.5, but as I've said so many times already, there is risk. If it was always giving 15.5, risk would be 0. Here, it might be lower, might be higher. Well, the more it goes up and down, the more risky. The standard way of measuring it, all we do is, first of all, we look in each case and say, how much higher or lower is it? What I mean is, it might give, the average is 15.5. If it gives 10%, we are 5.5% below average. If it gives 15, we're 0.5% below average. If it gives 20, we're up 4.5. You all with me here? I mean, if you want symbols, but you won't need them. That's what, I think it's all a bit silly. But we call these x, we call this x bar the average. But all I've done is looked at the difference between the various returns and the average. All right? Well, I've already said the more higher and lower it is, the more risk. Yeah? We want the average risk. Well, there'd be no point in averaging those as they stand. Why? You know, you could simply work out the average of those differences, 0.2, 0.5, 0.3. You could work out an average. Why would that be rather silly? Well, I won't waste your time. You try it if you want. You see what I'm getting at? The more it goes up and down, the more risk. Yeah? So we just want to work an average difference sort of thing. But if you take the average of those, you'll end up with 0. Because some are negative, some are positive. You try it, it'll be 0. It's all a bit meaningless. And so to avoid that problem, what we do, we square those, and then we take an average. Because by squaring them, the sign disappears. So 5.5 squared is 30.25. 0.5 squared is 0.25. 4.5 squared, 20.25. I hope somebody's checking. So these are the squares of the differences. And of course they're all positive because we've squared. But then we take the weighted average. We multiply by the probability. 0.2, 0.5, 0.3. Multiply and add. So check. We're not quite there yet, but I get 12.25. Everybody? Right. So we're almost there, but be clear what we've done. I keep saying you won't actually be doing it, but nothing that follows will make sense if you don't see the idea. I've said the bigger the differences from the average, the more the risk. Because of the sign problem, we squared the differences. So that 12.25, it sounds silly in words, but it's the average of the squares of the differences. If you see my point. Well, that in itself is, I think you'd agree, a measure of risk. The more the differences, the bigger that figure would be. The less the differences from the average, the smaller. You with me? And it's got a name. That's called the variance. And certainly you'll see later, even though you won't be calculating it, you can refer to the variance. So you've seen where it came from, but there we are. However, the slight problem, of course, is that 12.25, although it is a measure of risk, the more the spread, the greater it'll be. That's sort of squared percentages. Do you understand me? You know, the difference is 5.5%, but so that's like at squared percentages, which is a bit odd. And so more often, we make one more step to go back to the same units. Because that's squared percentages, we take the square root. The standard deviation or the symbol for it, which is sigma, which you could well need. We take the square root of 12.25, which is 3.5. And a small point, but do see that since I put in percentages, this was a squared percent, but having taken a square root, this is a percentage. The only reason I mention it, I keep saying, although you're very likely to need this, he will give it you, but you'd be told the standard deviation is 3.5%. Well, if you put percents in, you get percents out, if that makes sense. Now, is that making sense, please? I say, if you're going to be asked it, I'll give you some examples, but you won't. Yeah? You see where it comes from? One thing, though, that you better learn. It's difficult to say with this new examiner, but he says he's going to be like the old one was. And quite often, you will see shortly, there will be places you could need this standard deviation. Sometimes he gave it you direct. Other times, he gave you the variance. You'd better learn to be safe. The first of several formulae I'll write up today, which aren't on the formula sheet, that the standard deviation is the square root of the variance. It's an easy formula. You better learn it. Arithmetically, it's obviously trivial, but it's such a shame if you gave your variance and you'd forgotten. All right? However, the important thing is that is a measure of risk. The greater the standard deviation, the more risky it is, the bigger the spread. The lower the standard deviation, the lower. Yeah? Sensible? Well, fine. Again, I know I've gone off weighted average cost of capital, bear with me, because it's like a little bit on its own, you know, we come back later. But the relevance, of course, is that if anybody's making a decision of where to invest money, clearly you're interested in the return. The higher the average return, the better. But of course, you're interested in risk. That we assume everybody's sort of sensible, and the more risky something is, the higher the return you'll need, and vice versa. So, a very easy one, I hope, before I let you have a coffee. Look at example 2. And this has actually been asked, only as a little tiny bit of a question. But I've said there, imagine you're an investor, you're thinking of buying some shares or something. And those shares, the expected or the average return, you've got that list. And of course on that alone, I'd prefer share B, it gives me 25% return. Agreed? I've also, though, told you the riskiness. Of course, that, lower the risk, the better. Purely on risk, D and D seem to be the best. Yep. The problem is, though, that of course, I think you'd agree, you're prepared to accept more risk, provided you're getting more return. Well, what I'm asking you there, I don't want to know which is best, but there are certainly one or two of those that you certainly would not accept. Which ones, or one, would you not want?
A.
Was that an answer or a comment? Eh? Sorry, I'm joking. Reda says you wouldn't accept A.
The same return for her.
Yes, because if you compare A and D are both giving 20% return. Of the two, though, D has the lower risk. Well, if you can get the same return with less risk, would you all agree with Reda? You won't do A. D is better than A. Does everybody agree? Anybody else? I think there's another one you definitely wouldn't do. Anybody? Say again.
B.
B. Why wouldn't you do B?
C, I mean. Maybe.
Okay, why wouldn't you do C?
Because it's close to E, but twice higher.
Now, I'll come to that later. The trouble is it depends on the individual. But if you compare C and D, C is more risky, and that's a downside. But it is giving a higher return. Now, everybody behaves differently, but, you know, it's a question of, is 1% more return good enough for 2% more risk? Are you with me? Well, it depends on how you react to risk. So you can't definitely say, this is definitely better, definitely worse. But there is one here which any sensible person, one other one, any sensible person would never take. Sorry?
D.
D. Because if you compare D and D, they've both got the same risk. So in that sense, you're indifferent. But E gives a higher return. Well, surely, if you can get a higher return with the same risk, you're bound to prefer it. And so, the other one, what was it? D. Is it D? D you won't do. All right? So it's no big shakes. But I say this has been a tiny bit in an exam to check you understood. But the problem with the other three, you see, what are we left with? B gives 25, 6%. C gives 23, 4%. E gives 22%, 2%. The problem here is, which you'd prefer will depend on your attitude to risk. You'd be having to say, well, there is more risk. Is the extra return enough for the extra risk? Well, the problem is everybody's different, you know? You know, if I were able to find out your attitude to risk, You know, and it's hypothetical, but if we were able to say, oh, your Katerina needs 1% more, 5% more return for every 1% risk, then no problem. People do that. I don't know if any of you did this at school. They draw curves and things. But it's all far too hypothetical. The point is, you will definitely not do A and D. You couldn't be asked in the exam, which is the better of those three. You couldn't. You rule out those that you could, but then you'd say the decision between what's left depends on the decision maker's attitude to risk. Okay? Alright, so you're probably thinking this is all far too easy, but where this leads, and I'll give you a break first, otherwise you'll be bursting. Where it leads is something that I think might surprise one or two of you. But there are ways. You've all agreed that we all accept more risk if we get higher return. There are ways in which you can reduce the risk, which is great, without losing return. All right? That may make sense, it may not. I'll show you after the break how. It's lovely. And there's one bit that I think might surprise you. It took me 2 days to make up an example to show it. But anyway.